Hello again, everybody. In my recent 2020 almanac, I examined a lot of simple ideas that I think every system developer has thought about. Are there biases to, for example, buying the market after an up day? Or the other side of that, is there a bias, in fact, to buying after a down day and doing the exact opposite on selling short? Well, in the almanac, 2020 almanac that I just released, it was mishmashy. It worked in one direction on some of the markets and in the opposite on others. So, I, part of what I wanted to show people was stuff they may have thought about that they shouldn't waste their time on. Well, it turns out that you can get a bias on daily bars by just adding one little condition. All right, we set up our charts for daily bars, again, day session only, 8:30 a.m. to 3:15 p.m. Central Time. And we're looking at a down day, close to close down, okay? Today's close is less than yesterday's. And if, when you take today's close away from yesterday's close, you get a distance that's at least 75% of the 5-day range. Again, we're talking the day sessions only, 5-day average range. And the net change close to close is at least 75% that size. Then we buy tomorrow at the 8:30 a.m. open. If today's close, now this is following an up day, a day where today's close was higher than the previous day's close, okay? In that case, if today's close minus yesterday's close is at least 75% of the average 5-day range, sell short, okay? So we're fading the close to closes net changes, and we're saying that the distance between those two closes have to be at least 75% as large as the average 5-day ranges. Okay? And we exit at the 3:15 p.m. close. All right, this is what we get in the S&Ps. 855 trades. Certainly an adequate amount, $47,000 profit. This is on a study from the beginning of 2010 through April 9th, 2020. About 50% profit. $13,000 drawdown. Not going to give you any stops on this. Just going to give you, an overall tendency that could be very helpful to you in your own work. 364% return on account. Again, as I say a million times, that's the net profit, 47,000 divided by the worst drawdown, 13,000. And that gives you a percentage that your account would have increased had you started with that worst drawdown amount. Now, the problem I had in the book was I did get a bias. I forget even in which direction. I think it was going with the net changes in the S&P. But it didn't conform in the other markets. Some were going with the net changes, some were going against them. Here we got unanimity. Fade the net changes. Just do so by having that 75% range size rule in there. Okay? Best one of all, NASDAQ. $71,000 with a 705% return on account. You can dock pretty much anything you want from the average trade and still have a very good winning system. And even the drawdown isn't terrible. I would think that with just a little bit of tooling in there, you can get something that will limit your potential one trade loss. As always, if you do, I encourage you to let me know. So, again, everybody, stay safe and thank you for joining me.